presentation today will cover really the whole of Sub-Saharan Africa. It is mainly drawn from the work of our regional studies unit, which produces a regional economic outlook twice a year. You can find it on the website of the IMF. Now, the figures here are a bit updated because the outlook came out in October, so there's been a little bit of developments, but not that much. I will also try to touch a bit more on issues that pertain to emerging economies, frontier markets. Now, so what's the difference between a frontier market and an emerging economy? Well, it's a bit of a fuzzy difference, right? But essentially, frontier markets are countries that have started to access international markets and that typically issue sub-investment grade Eurobonds. There's quite a few of them in Africa now. Ghana is one of them, but Kenya, Cote d'Ivoire, and so much and so forth. So why are they important now? Well, first of all, they are a bit different from other low-income countries. Maybe they still access concessional financing, but they have access to international markets. So they represent a bit, two words of developing countries and emerging economies. But I'm going to talk a bit more about that later. Let me start with presenting what I'm going to talk about. First of all, how the pandemic evolved in Sub-Saharan Africa, why it looks actually quite different from the rest of the world. Second, what was the impact of the pandemic? What is the impact still now on these countries? And third, I'm going to look at outlook and for the coming year and years and the policies. And I'm going to talk a little bit more about, as I said, frontier economies and access to markets, and also debt issues, which are a bit the flavor of the month, certainly in IMF, but in many other institutions, and for sure in a lot of these countries. So let's start with the evolution of the pandemic in Sub-Saharan Africa. The story here is that apparently the impact of the pandemic, the evolution or diffusion of the pandemic in Sub-Saharan Africa has been much more contained, much lower than in the rest of the world. And you can look at these three curves here. The red one at the bottom, at the very bottom, is Sub-Saharan Africa. These are COVID cases, moving average per million population. And you can clearly see it's a completely different shape, right? So there's been a bit of a first wave in the spring, early summer. Then it went down as it did in so more or less the rest of the world. Recently, there have been a bit more cases, especially in West Africa, but it's still much, much lower than the rest. So why do we see this? So the first one may be cosmetic, in the sense that testing has been much less extended and also probably precise than in the rest of the world, and that you can see in the right-hand side. That's the number of COVID tests per 1,000 people. And of course, the region doesn't really compare with the rest of the world. At the same time, if you look at hospitalizations, actually they are actually, and deaths, they are actually lower than the rest of the world. So the testing certainly plays a role, but that's not the whole story. So the question is whether there are specific factors that are, about Sub-Saharan Africa. One is the temperatures. I mean, it's just warmer throughout the year, and people are more inside, so maybe it's easier for the vaccine, for the virus to dissolve. But also people are just not as close indoors as in other regions. But another important factor is interconnectedness. In fact, at the very beginning of the pandemic, which actually I did follow because I also work on risk and risk issues for the department and for the fund. So I was like really at the front line at the very beginning, and we were very worried about what would happen all over the world. And what we also looked at was the interconnectedness proxied by airline connections. And Africa was by far the least connected of the regions. And this can explain, of course, a lot. They said the impact has been also very strong on Sub-Saharan Africa, but perhaps on slightly different channels than the rest of the world. Now, this also shows that while overall the dynamic is still a difference countries, and the biggest impact, the hardest hit was Africa. Now the big line is doesn't. It's a bit of an outlier, unfortunately. Unfortunately, because I'm actually, I'm sitting in Washington D.C., so I'm either South Africa is probably, of course, for testing capability, but it's also more connected with the rest of the world. Now, what about the economic impact? So here, in general, lockdowns all around the world have had a huge effect on economic activity through travel, trade, production, and domestic activity. So here, the essentially direct impact on Sub-Saharan Africa lockdown. So what happened, how and really mostly elsewhere. The first one is about flight arrivals, and that of course collapsed because of much lower demand for travel, for tourism in other regions into Africa, but also because of the closure of airspace and borders in African countries. And this was particularly devastating for countries that depend mostly on tourism, where we're talking about countries like Mauritius, Seychelles, and for these countries, not just of economic activity, but also of fiscal revenues, because a lot of fiscal revenues come from that. Now, second, export volumes. And this is the effect, of course, lower demand in the rest of the world. But it does affect particularly commodity exporting countries in the region. And then the terms of trade this is the last chart to the right, is also worsened a lot, particularly for oil exporters. And now this is also not just in Africa, but in all the oil, including obviously the Middle East and in the middle. So countries like Nigeria, for example, were really severely affected by these. Now, oil prices did go down a lot at the beginning, as you can see. They have recovered. I think now the most recent price is about $45, $50. A big component of the current account in many different countries. So here we show the wheel, the World Economic Outlook has a projection of declining of 20% in remittances. Now, actually, this has been a bit of a surprise in the sense that if we look at more recent data on remittances, it turns out that in several countries, they have held up actually pretty well. And in the country, in my own country, in Ghana, they actually increased compared to last year. And this is actually, it's something that it's not ex post is not so surprising. In situations of crisis, very often the workers abroad send more money to the home country. Now, you would think that if you have a systemic crisis that affects all countries in the world, you will not see that. But in fact, actually, this phenomenon happened again, and I think it's quite interesting. And then on the right-hand side, we see the portfolio flows. Now, this is actually quite relevant, particularly for frontier markets. You can see that these are cumulative portfolio flows. There are two lines. One is the global financial crisis, is this one here, and this one is the what's happening now, the COVID crisis, and these are weeks, right? So this is the start of the crisis and the evolution in time. And what happened is that at the very beginning of the pandemic, there was a big outflow of capital leaving frontier markets due to risk aversion and also the need to settle positions outside the region. But then there was a re-entry of capital, which, however, has not managed to compensate yet because we are here, right? So we are below the zero. It has not compensated yet the outflow of the very beginning. And of course, the story here is the global liquidity injection by the central banks, of course, the euro area and the US, and the change in risk attitude of investors. And this was really quite incredible. I mean, we were literally following this day by day at the beginning, and there was a huge concern that the pandemic would translate into a global financial crisis again. And we, it was actually quite amazing how this was stopped and reversed, and you can see it, really very clearly here. Now, FDI is not shown here. FDI has decreased also this year. That's a bit tricky, right? It's a bit less clear. The determinants of FDI are a bit less clear, and uncertainty plays a big role. So the question is, how fast are we going back to normal activity? What are the investment perspectives? These are all factors that drive FDI, and I would say that this remains quite uncertain. Now, what about access to markets? And so let's go back to the theme of frontier economies. So these are countries that have, of course, a past of purely low-income countries, and that have morphed, right? So they used to be very dependent on concessional financing. That dependence has decreased. For example, Ghana has this big economic plan, which is called Ghana Beyond Aid. So the idea is to do without concessional financing at all, and so they have shifted towards commercial borrowing, right? And that is loans and various operations, PPPs, and things like that, but also Eurobond issuance, so access to international capital markets. As I mentioned, at sub-investment grade. So the spreads are still pretty high, but still very attractive, right? So typically these countries used to be able to borrow. Like Ghana borrowed $3 billion last year in February at between 8 and 10%, and this was way oversubscribed, right? And Cote d'Ivoire even managed to borrow I think a few weeks ago, $1 billion at 5%. And so we are, for my Ghana work, I'm in regular touch with investors, and it's amazing how these guys are just, ready to jump on issuances. And in fact, if you look at the behavioral spreads, these are spreads over U.S. securities. The MB, which is, of course, the benchmark is down here. These are the countries, Senegal, Cote d'Ivoire, Ghana, are all above, obviously. But the shock at the beginning, this corresponds to the area where you have the outflow of capital at the beginning of the crisis. And then the spreads go down and now are back. Now, Ghana is the red one here. You cannot see, but now it's actually at the pre-pandemic levels, which is, frankly, amazing. So this means there's a search for yield. The global liquidity is doing wonders. So we need to see what happens next year. Now, there is still a lot of uncertainty in the sense that the global financial conditions could change. Something could happen. The pandemic could not go away. Vaccines may not work. You may have an emerging market crisis. Interest rates in the US could increase. I mean, a number of reasons, right? So we still haven't seen a widespread return to markets. Ghana actually plans to issue in early 2021 something like $3 to $5 billion. So we'll see how that works. Now let's also keep in mind that these are very, very small markets. These countries represent a fraction of the global issuance of Eurobonds. So they are really completely marginal players. These are niche operations, right? So in a sense, what happens elsewhere is what affects the prospects or market access for these countries. Now, in terms of activity, and let me go back to the question of impact on economic activity. And I talked about the indirect impact, so what happens in the rest of the world and what effect it has on the region. And now let's focus a bit on what happens in the region. And the lockdowns were extensive in Sub-Saharan Africa. Basically, all the countries did something about it. You can look at, there's a nice policy tracker on the IMF website, which follows what every country did in time. They all did the same, right? They all sort of shut down congregations, economic sort of services, closed borders, everything. Now, the difference is there are a few differences compared to what happened especially in advanced economies. The first one is that it's very difficult to impose lockdowns on countries where administrative capacity is very limited, right? It just cannot do it. There's a lot, it's a big informal sector, and which is very difficult to regulate. The density is much lower, so it's very difficult to do. And the second reason is that the impact on household can be very dramatic, right? The number of households that are close to the poverty line is much, much bigger than in other regions. And so this means that when you have something like that, which essentially stops people from being able to go to work or go to the market and trade and do these things, they just go below the poverty line, right? And this is something that essentially countries could not accept. So the bottom line is that these lockdowns were not particularly stringent, and they didn't last that much. And you can see that in the activity indicators. This is no casting. That's a fancy term for techniques that look at high frequency data, typically like mobile phones. Google, there's a whole Google operation about this. And the fund is doing a lot of work. It's actually very, very interesting. And this shows where economic activity, you can see clearly the big rebound in Q2, at the end of Q2, and then where we are now. It's actually fascinating because let's also not forget these countries have very, in general, not particularly good statistical data. And so the whole mobile phone technology and data gathering and big data has made them sort of leapfrog really in terms of analysis of economic activity and many other things. So this said, overall, the impact is negative. The contraction in the region on average is going to be 3%. That's the worst decline in GDP on record. And that's about 7 percentage points lower than the IMF projections 1 year ago. So that's before the crisis. Now, all the countries have been affected. The worst affected countries have typically been tourism-dependent countries and oil exporters, right? So small countries like Seychelles and Mauritius, and big countries like Nigeria. Now, the countries that have done relatively well are the diversified economies, typically that depend in part on sort of commodity exports, but also have a strong domestic economy, like Rwanda and Cote d'Ivoire. And Ghana itself has actually done relatively well. We still see a growth of 1 to 2% this year. And the reason for Ghana is that they export gold, right? They export oil and cocoa, but also gold. And gold prices have skyrocketed because of the flight to safety. So, in other words, diversified picture, but overall negative. Now, as a comparison, the projection for the world is a contraction of 4%, right? So it's a bit less than the world and a lot less than many advanced economies. Now, another way to look at this is to think in terms of development. These countries are developing, and so these are a very fancy chart that shows on the left-hand chart, on the x-axis, there is the decline in per capita growth. Okay, this is the decline per capita growth. Now, this is actually much higher than the declining growth because of the higher growth rates of the populations. And then on the y-axis, you have the corresponding number of years of income that has been lost. And essentially, you can see that a lot of countries will lose this year something between 5 and 10 years of income, which is actually quite a lot. All right. So let me move on to outlook and policies. And here, that's the future. There is a return to, we project a return to growth to the levels of real income of 2019 by about 2022. But for some economies, typically the oil exporters, this is going to take longer. The fund has also prepared a downside scenario that's at the bottom, where there is the assumption of a second global outbreak in 2021. And this means that for many countries, the return to 2019 levels will be much, much later, including for oil exporters in 25 risks. So the idea here is a V-shaped recovery, right? So the idea is that the worst of the crisis was in 2020, typically in the middle of the year, and then there's a big rebound, and then things are kind of going back to normal, right? That's more or less the philosophy of these projections and of the WIO in general. There are still large risks, obviously. One is that the pandemic evolution in Sub-Saharan Africa and in the rest of the world may be quite different. Vaccines may not work, may be distributed very difficult in here. For Sub-Saharan Africa, obviously, it's going to be much longer because of the problems in distributing vaccines and the access to vaccines. And then, of course, we have the usual risks about commodity prices and the like. But essentially, the central factor is what is going to happen, the pandemic, and how fast Sub-Saharan African countries will be able to access the vaccines. And if there is interest in that, I can talk more about the vaccines and the whole story about low-income countries. Now, what does this mean for policies? You can see on the left-hand side, increase in deficit. Now, the interesting thing is that deficits have not gone down as much as in other regions. And the reason is the fact that financing capacity is much more limited, right? So these countries literally cannot access financing to increase the deficit. So even if they want, they cannot really do it. This is also the reason why countries will need to consolidate much faster. And here, the right-hand side chart is it's a bit difficult to follow, but on this line, on the y-axis, you have the decrease means, of course, you go up, this is known as SSA, and the debt is on this side, right? Essentially, this shows that you have much bigger deficits in advanced economies, if we want to compare to that, than in Sub-Saharan African countries, but they need to return to sort of consolidation quite quickly, and they also need to reduce the debt. Right here, you see the debt more or less remains constant at much higher level than in Sub-Saharan Africa, and here a reduction. Now, this is a bit of a complex. It's a bit of a complex issue because these countries obviously would need to respond from a fiscal point of view as other countries did, but they cannot because they don't have financing. So they do a bit, they do what they can. They do it typically borrowing. They also borrow from the fund, but then they will need to repay, right? And so in a sense, they will need to sort of cancel the fiscal stimulus. In fact, inject the negative fiscal stimulus in the economy faster than other countries that have more borrowing capacity or that have reserve currencies. And that's typically, of course, the the advanced economies. Now, this is a bit of a zoom in on the debt. And so the debt has been was a big theme before the pandemic. It remains a big theme now. What's interesting now, this is just from 2016, but if you went so here, what you will see is that the debt after the big debt relief operations, the HIPIC and MDRI between, say, end of the 90s and 2010 or so, the debt was canceled, went much lower, and then it started to grow again. So we are basically now at more or less where we were before the HIPIC initiative. So a growth of that basically in all countries in Sub-Saharan Africa. There is a change. The debt has become more commercial, less official, less concessional, and especially less bilateral, official bilateral, right? Official bilateral typically of the traditional big donors, Western countries, Paris Club. And now it's much more, in fact, the new debt is always mostly being China, right? So that's non-Paris Club, a non-Paris Club creditor, but also there are other countries like India or Kuwait. So that's the official part, and the mix. So the line between official and commercial is a bit blurred, especially in the case of China, right? Because you have some big agencies, China, that lend at commercial terms, and they don't see themselves as commercial, but essentially also part of the official policy of the Chinese government. So it's quite complicated, and. The other factor is a big development of the domestic debt market, and that is part, of course, of the development story. And the fund has done, the World Bank have done a lot of work on these. It does change the picture in terms of how governments are financing themselves. Now, this part here is sort of a bit of a typical fund projection where debt peaks and then goes down. But it's predicated, of course, on a return to sort of growth, relatively high growth rates, and fiscal consolidation. So let's move on. So now, if we look a bit at the quality, what is the situation of countries? Here we have we show the classification of sort of risk of distress in the context of the IMF. Especially you have sort of low risk, moderate, high risk, and have debt distress, right? What happening here clearly after HIPIC, a relatively high number of countries at low risk, that number goes down, and the number of countries that are at high risk or are in debt distress is actually much bigger, right? Now, what the debt distress, what does that mean? Now, in the context of low-income countries that don't necessarily have market access, it's a bit of a fuzzy Eurobonds. And what the most famous case right now is Zambia. Now, as I mentioned before, that has changed, And so what's happening now with these countries that are in this situation, the distress, is actually quite complicated. It used all to be sort of dealt with at the Pies Club, essentially, and sort of some sort of spin-offs, but it was all done there. Now the presence of China makes things much more complicated. A lot of the debt is with China. There's a lot of debt which is commercial debt, like Eurobonds. So you now have problems and issues that were typical of emerging markets maybe 20 years ago, 30 years ago, and that are now for countries like Zambia, for example. Now, there is a big push at the international level for a solution to all this, what to do with countries that are in a situation of debt distress, and the expectation, of course, there will be many more. And one outcome of this push is the common framework of the G20, which is essentially, if there's interest, I can talk more about it, but it's essentially, it's a unified approach. It's more about the process on how to deal with this crisis, bringing in all the creditors, including China, and possibly also commercial creditors. And that's quite a progress, but I would say we are not completely there yet. So, looking forward, what is it that we would like to see in Sub-Saharan African countries? First of all, domestic revenue mobilization. There is a big problem of raising revenues for countries. More needs to be done because these countries cannot just depend on borrowing and on concessional flows, because these are in any way declining. Second, there will need to be a focus on social protection because of the impact of COVID, and the fact that the policy trends in many cases have actually been the direction has changed. There is opportunity, and many countries are leveraging these for leapfrogging in terms of digitalization and connectivity. And the last one is about transparency and governance. And here at the international level, certainly the IMF and the World Bank are pushing a lot on this, on sort of coupling support to countries with more transparency and better governance. But also, and here is my last big theme, there is a question of external financing, of transfer of resources. These countries have been hit, right? The fiscal revenues have been hit, the debt has increased. We do project actually a pretty large financing gap of between 130 and 410 billion dollars, and that's the area here, and that's and this is really what is missing in the financing sources. These are financing needs. So if you look at this column, this PHT eligible, these are essentially low-income countries. These are the countries that are sort of at higher income level, that are not eligible for the concessional window of the fund, which is the PHT. So the sort of overall amount of financing needs is just not met, but what we expect is going to come from private flows and official flows. So there is an issue there. If this financing this gap is not covered, the solution is a fiscal crunch, and so much lower investment, much lower development. So it's really an issue. It's difficult to expect donors to make up for this amount. The budgets in all countries in the rest of the world are under huge pressure. So this is a bit of an open question, but it's important to keep in mind. So let me conclude here and just summarize very quickly. The recovery, we do see a recovery, but we also see it quite difficult with large risks. The fund has insisted on prioritizing the protection of the lives of the population and livelihoods, so that countries, governments should do what they can and to protect that. But the same, there is a bit of a tension here, right? Because we also expect debt to be brought back to sustainable levels, because a sort of stable macro economic framework is a condition for for growth. And we also recommend, we also expect to see transformative reforms, right? Changing what I was mentioning before, changing the economy, promote sort of a more inclusive and sort of also greener economy, but also the problem of external support, right? As I mentioned, there is a big financing gap there, and how is that going to be filled? So I think that's it. So Francesco, I don't know how you want to proceed. I'm happy to take questions, and maybe I